Welcome to the show, everybody.
All right. Here we go. Middle of August, bro.
Yeah, I'm going to say it again and say it every week. What a crazy week.
Yeah. I can't even keep it all straight anymore.
Yeah, we're in for a wild ride, I think, for the rest of the year. Yeah, I mean, just thinking about the election in November, we still got ways to get there.
Yeah.
All the things happen in the financial world, not looking for much calmness.
No, there's going to be big swings in both directions for sure.
Yeah. Lots of opportunities.
Yeah. Tough to take those opportunities in TSP.
Yeah.
Very, very tough. Really good if you're in a separate account and you have the time to sit in front of your computer. You can do really well.
Now's not the time to sleep on your TSP. No. Especially if you're in one of the stock funds or something, if you're in there and you're not paying attention. You have to pay attention. If you don't want to pay attention right now, just go to the G fund.
I mean, if you care about, if you want to just roll the dice and close your eyes and don't look at it, then fine.
Yeah, it's not the time to do that, though.
I wouldn't recommend it.
Let's get into it.
All right, so August 11th. So we're going to take a look at a recent Facebook post and kind of talk through some of that. Then I got a kind of a list of what happened this week. So many things going on. It started last weekend, but so much came out this week. This thing called the yen carry trade. We're going to just talk about what that is. It's been all over the media, and we'll talk about what that is. We did recession, and we did the SOM rule a little bit last week, but I just want to kind of do what a recession is, what a SOM rule is, and how it really affects government employees. Tesla is the bonus chart, and TSP fund charts. So we got this Facebook post early this week. Said it was 2 days ago, but like sometime early this week. Person says, I'm retired. With all the posts about moving funds or percentages, how does this affect retirees? Which I thought was an interesting question because most of the time we're talking about people that are employed and continuing to contribute and have time. If the market goes down, they can recover. So I'm confused. Prior to retirement, my percentages are G 65%, C 30%, S 5%. So pretty conservative, right? 65% G, 30 C, 5S. Should I leave it this way? I'm not contributing anymore. And will I lose money if the market does crash? So you're only 35% exposed to the market. So that's good. I mean, will you lose money? Yes. If the market crashes, yes, but you're only 35% exposed. If you had been 65% G fund for a long time, like there's no timelines here, but prior to retirement, how long prior to retirement were you 65% G? You lost a lot of gains this year. So it's a balance, right? But these two answers I thought were pretty interesting. I think a lot of retired people are on the edge of their seats right now. Yes. This person is 50C, 50G, so also kind of pretty conservative. Third quarter is normally weak. I should have moved in July. Everybody, if we had a crystal ball, everybody would have moved on in July 16th, whatever the top was. I don't depend on TSP for income, but we're hoping to buy a retirement home in another city. I'm ready to move mine to an RIA, let an expert handle it. Of course, most major funds have lost money this month, but the hit the last few days has been hard. I'm hoping for a high tomorrow so I can move to the G. A lot of stuff in there. So this person, if you're 50C, 50G, okay. If you're planning on retiring and buying a retirement home in another city, if it was me, I'd be 100% G fund. If I'm going to use that money to buy a house, I'm not going to be 50% exposed to the C fund at this point. But that's just me. If you're identifying that to use that money for something in retirement and it's coming up soon, I wouldn't be dealing with this volatility in the market right now. And then moving it to an IRA to let an expert handle it. It's possible that you could find somebody that actually manages money, but you have to give them a lot of money for them to manage it for you. Manage it meaning something other than putting it in a high risk, low risk, medium risk bucket, come back once a year and check it out and see what happened. The infinite majority of RIAs do not manage money that's kind of the way we do. And this person was right. Most major funds have lost money this month. That's true, right? So if you were following along with the grow model portfolio, you did not. But most fund managers don't manage money that way. So definitely do your research if you're gonna. Don't just roll it into some Fidelity, IRA.
Yeah, well, the thing is they're not fund managers, really.
Right.
The key takeaway there is, you're going to run into two types of people at kind of what I would call the low end. And I don't mean low as you have a certain amount of money. Actually, it is that, right? Yeah. If you don't have, several $1 million, you're not going to get a advisor. Let's just call them that, financial planner or investment advisor. Those aren't the same thing, but they can all get mixed in together. Yep. So a certified financial planner, a CFP, those folks help you take a look at your entire world and put that together for a plan. And that is a very good thing. And you can find lots of those people out there for fee-based. They'll do it for a reasonable amount. They're not normally going to be a person that manages a portfolio. If their firm does it, they outsource it. Yep. Right? And even the outsourcing may just be passive models. Then you got the investment advisors who don't really do that planning stuff. They may have other people that do it, but investment advisors are your first kind of level of portfolio management. Most of those folks still outsource it to a third-party models. They just give, whoever they work for, Fidelity or, TD or whatever, whatever company you go to, they just have a batch of models, and they get paid a lot of times on the models they use, and that's going down a whole different road. But the bottom line is, most of those people at that level are not actively managing a portfolio. They're not in there making the changes. They're just accepting it from somewhere else, a given model. The more you move towards that, the more money you have to pay or have or both. That's what Jerry's pointing to. I mean, you start moving towards hedge fund models there. Now, we are starting to see some companies, some firms make actively managed ETFs. And these are very interesting things. I'm not recommending them because it's still early and we haven't seen performance. They still got to perform well. Yep. But that is very interesting. When you see, we know of at least two, and I can't think of them right off the top of my head. I'll try to put them in the comment section.
Mike Green's. Can't remember the name of the company.
Yeah, the companies though. I can think of the people. I can't think of their companies. But anyway, you can search them out. They're ETFs that are actively managed. What that means is they treat it like a hedge fund inside an ETF. Does it work? Who knows? But to Jerry's point, turning your money over to, an RIA out there is not just a given that, they're going to do well, because they might be more passive than you are. Right. Right. Because at least the person that you're reading off sounds like they're at least actively engaged. Right. And you're probably not going to get that from an investment advisor at low level. Now, let's assume you have $1 million in there. Is that enough to get their attention? Yes. Is that enough to get someone's attention who actively manages a fund? I don't know. Yeah.
You definitely got to do the research. And the second one, this person has been retired for 10 years. Had a third in C, a third in S, bleeding money like everyone else, but I keep remembering that unless I go for it, I'll never be big time rich. So I'm considering my third I have in the G fund and investing all of it in the C when I think it hits the bottom. I was always going to be conservative when I retired, but I'm ready to go for it and see what happens. It's a gamble, but I'll either be rich or almost broke. You almost may as well go to Vegas.
Yes, it's scary. I mean, I could see some of that being a little just kind of tongue in cheek, maybe. Yeah. Hopefully.
Hopefully.
But I mean, the person realizes they're gambling, so there's not much you can do. I certainly wouldn't want to gamble with my retirement fund unless it's if we're talking a couple $100,000 and it's not going to make a difference in your life. Okay, if you're talking 500,000 or 700 or $1 million, heck no.
I mean, for me, it's a matter of how much do you in your plan, how much does that money in TSP, how much are you going to withdraw to use in retirement? If you've been retired for 10 years and you haven't had to tap TSP at all, then if it's money on the side and you want to put it on red and roll it, then great.
As long as you know that you're doing that, it is what it is.
Yeah. So interesting. So back to the original person. Obviously there's a lot of comments in here. And you really got to kind of sift through them and figure out what works for you and your personal circumstances and risk tolerance.
Yeah, I wouldn't take financial advice on Facebook
groups. Nah.
And if you'll notice, I'm saying that, and but you guys have the Facebook group. Yeah, but we don't give advice in it.
Yeah.
We try to educate people and try to give them, guidance towards, learning some fundamentals, but we're not giving anybody investment advice in there. And you shouldn't take it from in there. You should go find someone, that is a financial planner or a registered investment advisor, and that's the best you can do, at this level.
I mean, hopefully if you go into a fee-only financial planner and you say, I have $1 million in TSP, my Social Security and my pension are going to be X, I got $1 million in TSP, I already paid my house off, like that's one way, right?
Yeah, they're going to figure out your personal circumstances and start from there.
Right.
And your risk tolerance.
Yeah, that's really the value of going to those guys. All right. So what happened this week? Monday, right? We wake up and we have this huge collapse, worldwide collapse. U.S. is down 3%, U.K. down 2.6%, Australia down about 2.5%, France down almost 2%, but that it had already been down. And then Japan was down almost 5%, but it had been down like 25% over the last 16 trading days. It's crazy. But then all the indexes were off the session lows by the end of the day on Monday. So they found some support by the end of the day on Monday. And then on Tuesday, we had a pretty strong rally, but it got rejected at that 20-week moving average line. It finished the day up, but in the lower half of the day's trading range. So not a bad day, but not super bullish either. And then Wednesday morning, we got a big rally on the statement from the Bank of Japan. Bank of Japan comes out and says they're not going to raise rates. And we're going to get to that in the carry trade. But the big thing was Japan comes out and says, well, they had raised rates, and that caused the problem in the first place. And they came out on Wednesday and said, okay, we're not going to raise rates if there's continued volatility and all that in the market. And so that is what big rally on Wednesday. But then it rolled over, right? And the rally fails by the end of the day and takes out all of Tuesday's gains. So really volatile. Up big on Monday, up big on Tuesday, but then reversed and came all the way back down and takes out Tuesday's gains. Then on Thursday, we get a better than expected job report, right? And that leads to a pretty broad rally on Thursday morning. It ended up closing up significantly for the day, but it was not able to get above Wednesday's intraday high. Okay, so now we're creating upside resistance. And then on Friday, there really wasn't any economic news. We're doing this about noon, and the market hasn't really moved. It's pretty much flat for the day. So the big question is going to be, can the S&P finish above its 20-week moving average line for the week? All right, so this yen carry trade. So here's kind of how it works, right? Imagine you go, so this was from realinvestmentadvice.com. This is kind of the example that they used for their people. Let's say you're a hedge fund, right? You go to a Japanese bank, you put $100,000 down as collateral, and you borrow $1 million worth of yen, okay? A couple of weeks ago, it was an interest-free loan, okay? So your loan, the amount you have to pay back in interest is zero. So you take the yen, you convert the yen to dollars, and you buy one-year treasury notes at 3%. So that's almost as guaranteed as the G fund, right? You're going to get that 3%, and you're paying 0% for it. So it's like free money. So assuming the yen's value doesn't change versus the dollar, right? Because you had to convert your 100,000 to buy $1 million worth of yen, which means you're 10 times levered, right? Your leverage is 10 times. So assuming the yen's value doesn't change versus the dollar, your return is going to be 30%, right? 3% rate of return that you got on the treasury bill times your 10% leverage. So you get a 30% rate of return, which guaranteed, right? Because it's a treasury note. The problem is if the yen appreciates when you have to pay that loan back, right? So if the value of the yen versus the dollar goes up, it eats into the profits that you had. So if the yen appreciates by 1% over the year and you didn't hedge against the currency risk, the return that you had, your 30%, falls to 20%. And if there's a 5% appreciation of the yen, you end up with a 20% loss. So what looked like a guaranteed easy money trade, which is a carry trade, because you're betting the difference between borrowing at 0 and getting guaranteed 3%. And that's all fine as long as the currency stays the same. But what happened was, this is a chart of the yen versus the dollar. So the yen versus the dollar had been coming down for a long time, and it bottomed and spiked. So now when you're trying to pay those, you have to reconvert into yen from dollars. You're paying much more for the yen than you did back when you borrowed the money. And so if you are at a loss, you have to sell assets to pay back those yen. And people were selling, investors were selling NVIDIA and Bitcoin and all the stuff that they had made a lot of money on over the past year. And that's one of the things that definitely contributed to the decline we had in the first couple of days, end of last week, beginning of this week. So that's what they're talking about when they're talking about the yen carry trade. All right, recession and the SOM rule. So recession, it gets talked about all the time, and people don't really understand what it is. This is a simple definition from Investopedia, but the definition of it is a significant, widespread, and prolonged downturn in economic activity. Okay, that's basically the definition. That's it. The rule of thumb, and it's just a rule of thumb, is that 2 consecutive quarters of negative GDP growth indicates a recession. Okay, it's not a mathematical exact. So the National Bureau of Economic Research, they're the ones that are responsible for coming out and declaring that the economy is in a recession. And they use a whole bunch of different tools to do it, but they point out there's no fixed rule about what measures contribute information to the process or how they are weighted in our decisions. They decide whether or not we're in recession. So we had 2 negative GDP quarters at the beginning of 2022. So I think it was the last quarter of 21 and the first quarter of 22 were both GDP had contracted, but it didn't trigger a recession. And there was a lot of talk about that at the time. A downturn must be deep, pervasive, and lasting to qualify as a recession by National Bureau of Economic Research standards. Since some of these qualities may not be evident when a downturn first begins, many recessions are called retroactively. That's the understatement of the day, because if the recession has to be deep, pervasive, and lasting to qualify, then it has to do those things before they can say a recession is in place. So yes, they're not going to be able to say we're in recession at the beginning of it. Most of the time, by the time they come out and say, yeah, we're in recession, we're close to the end of it. And so this is why the SOM rule becomes really important, okay? So the SOM rule is a recession indicator, right? It's telling us that we're beginning a recession as opposed to when the recession is officially declared. So the indicator is created by Claudia Sahm. She's a macroeconomist, worked for the Fed and the White House. So according to the rule, the early stages of a recession is signaled when the 3-month moving average of U.S. unemployment is 0.5 percentage point or more above the lowest 3-month moving average unemployment rate over the past 12 months. So it's complicated. It's not really complicated if you look at it, but what it basically tells you is the rate of unemployment is increasing at a significant rate. So ordinarily, unemployment it oscillates up and down, but when it starts moving higher and it gets to a certain point, it's going to continue, right? That's the idea. It's going to continue. So the acceleration of the unemployment rate is what the SOM rule is about. It's been recognized for accuracy, simplicity, ability to reflect onset of a recession, and it's never been wrong. Going back to 1970, it's never been wrong. So this isn't exactly when the SOM rule triggered in any of those cases, but what I'm pointing out here, this is the unemployment rate, okay, from the Bureau of Labor and Statistics. That's the black line. So unemployment basically oscillates, right? And then once it starts ticking up, it keeps going. It doesn't just, once it gets to a certain point, momentum is behind it and it keeps going. And 1990, we had that recession, right? And then it bottoms out and starts turning up. It gets to a certain point of momentum. That's 2001, right? The top of the tech bubble. 2007, right? Housing collapse, great financial crisis. Down here at COVID, kind of a one-off because it just spiked because the whole economy shut down. And then where we are right now, you know, it's ticking up, and very likely unemployment spikes like it did every other time. So that's really the recession indicator that people are kind of freaked out about right now. Interestingly, back here in 22, so right here, clearly the unemployment rate is decreasing. Even though we had 2 quarters of negative GDP growth, the SOM rule didn't trigger a recession. And so it's one of the reasons why people are saying, yeah, we didn't have a recession back then, even though the conventional wisdom is the 2 declining quarters of GDP growth, you know, so that's why. But this is a problem. This is what everybody's kind of spun up about. Okay. Tesla. So this is a long-term view of Tesla, right? It's a weekly chart going back to when Tesla first begins. They haven't had any major declines, but you got a bunch of kind of consolidation periods. So we had a big spike up, and then 2 years of consolidation, another big spike up, which happened pretty fast, right? 1 year, big spike up, and then years of sideways, and a huge spike up. And now we're in another consolidation period. So if history is any indication, the next move should be up, right? So if you are a long-term investor in Tesla, that's what you're kind of looking at. And this line, if we can get above it, you know, we got a low, a lower low, a higher low. So you could call this a left shoulder, a head, a right shoulder, and this is the neckline. And if we can get through, so we had a fake false breakout there. If we can get through this neckline, Tesla keeps going. So if you look at it on a short term, this is kind of where we are, right? It's a weekly chart. We had a failed breakout right there. Came down pretty hard for 3 weeks, trying to hit a bottom here. As long as it doesn't get below, that's about 165. As long as it doesn't get below that low, if you're long Tesla, you're in pretty good shape, I think. Definitely if it gets below here, we got a problem. All right. And this is, I'm not saying to buy Tesla. I'm just saying it's a learning tool, right? It's just a chart and how you would.
Yeah, that's why we do these bonus charts.
To it.
Yeah, the bonus charts are just something to look at besides the TSP funds,
right,
and teach you the same stuff. When you learn these, these indicators and tools that we're always kind of describing, you can use them on anything that you can chart. Doesn't have to be the TSP funds.
Yep, absolutely. Okay, TSP funds. So this is kind of interesting. Weekly chart of the C fund. I went back and I tried to find a place where we got one candle below that 20-week moving average line. And I didn't just go back to 2022, but honestly, I couldn't find anything any further back. So this probably is the closest, but this candle came off of last summer's correction. So we had a couple of months of correction before we had that one really big breakout candle. And so if you drew this trend line, this was really the week that you knew, the trend had changed and was going back up. And where we are right now, you don't have that. I mean, the trend, this was a good week, right? We definitely pulled back from those lows. So it was a good week, but the trend is still definitely down. We definitely want to see price close above that 20-week moving average line. But then next week, if we stay up here and keep moving, then fine. This is an odd, spike down, and we keep going. That's certainly possible. But most of the time, when you get a close below that 20-week moving average line, it keeps going down. So we'll see what happens next week. S fund, we've been talking about this breakout. It rallied for a couple of weeks and then failed. I mean, spectacular failure last week on the S fund. Trying to recover this week, but we'll see what happens. I mean, that's a great chart of all kinds of volatility going on in the market. iFund, same thing we've been talking about forever. Triple top at 82. Tried to get back above it, couldn't do it, failed. Tried to get back above it, couldn't do it, failed. And then we failed this upsloping trend line last week. Again, this week's trying to recover, but the iFund is not looking great. F-Fund is really the only fund that we're in, that we have in TSP that's actually trending higher. And F-Fund did break this left shoulder, head, right shoulder, neckline. Last week, we had a breakout in the F-Fund. So we had a little bit of a pullback this week. But we know that the Fed is beginning a rate cutting cycle. And when rates go down, bonds go up. So every indication is that the F-Fund should continue higher. And if recession does become a problem, stocks likely drop and the F-Fund can move significantly higher. Okay. That is all I got for today.
That's all you got. That's everything.
There's a lot of stuff in there.
All right. If you like this kind of stuff, make sure you check out our website if you're not familiar with it. And particularly if you like it, share it with your friends. Let everybody else know so they can watch. We love doing this each week. Give you guys a good wrap-up of what's going on in the TSP funds and otherwise. If you have any questions, make sure you put them in the comment section wherever you found the video. YouTube, Facebook. If there's not a comment section, you can always shoot us an email at support@growmytsp.com.
Alrighty.
You guys have a great week, and we'll see you soon.
Out of here.